Hey, welcome back. Despite a small recovery from last year's lows, Walgreens is still down over 80% from its peak. They reported an expectable year, but most importantly, took some important action that the market really didn't like, which is completely stopping the dividend after already cutting it in half a year ago. Now, it may be hard to believe, but from the looks of it, the market might have actually expected them to pay a 10% or even higher dividend during a time when they tried their best to avoid bankruptcy, but more on that in a bit. Now, the real issue is that they are restructuring, closing stores, trying to repay the debt, and on top of that, they are even losing money, which can be quite a problem. Stopping the dividend is a logical step, and I'd rather see them stop it and survive and recover than get a 10% dividend today and see them file for bankruptcy tomorrow. Surprisingly, they maintain the EPS guidance despite the challenges, but at the same time this is significantly less than before. Now, probably an even bigger issue is the current and especially future environment. Even if they recover, the market won't be the same, but we'll get into that later. They lost money recently, but before we saw them making a solid 3, 4, even 7 billion per year. For an 8.5 billion market cap, any of this would be amazing today, but that was before. We see them doing a lot of cost savings, closing stores, and doing whatever they can to survive and turn it around. So if they recover, the company should be smaller, keep that in mind. Now, as I said before, the CEO is applying the shock therapy that they need. After cutting it in half recently, they finally stopped the dividend after more than 90 years of payments, and I have to say again, be very careful with historical data. Especially in this case, data is worthless without context. I mean, this was a few years away from becoming a dividend king, meaning 50 years of consecutive increases, not only payments. If you look at the company even 10 years ago, you see much better margins constantly, tons of cash flows, and not that much to worry about overall. Sure, they had problems before, they went through recessions and stuff, but that doesn't say anything about the future. If anything, having to constantly increase the dividend no matter what if you don't want the stock to crash forced them into maybe not investing enough, and now we see the consequences. Disruptions like Amazon combined with the industry developing into lower margin sectors and the pandemic, while they had a huge dividend to pay, led to the current issues. No graph could have predicted this. If on top of this the investments they did were bad, which can happen, they don't get that many chances to do better. But if they manage to stabilize, which won't be easy as you are about to see in a second, this could become a nice turnaround story. Now they are in quite bad financial health. On top of bleeding money, which they are trying to stop, the current assets are further and further below the current liabilities. That means at least some of the difference, depending on the timing, will have to be funded with even more short or long-term debt, which for a company in this position in the current market would come at very high rates. We are talking about even low to mid double digits, so very very high. Plus, there is a lot of debt due in 2026 and 27. Around 2.8 and 1.8 billion will become due, which when you don't make money, don't have it on the balance sheet and can't really issue stock, the only viable option is refinancing or selling some assets. They actually said they are looking into getting additional debt and refinancing. Again, in this shape and the current market, refinancing would cost a lot. So definitely even more interest than the current 2-3% per year, leading to lower cash flows if they don't improve, which can snowball into very serious issues. Plus, they have negative equity after goodwill, not to mention the value of the intangibles. A majority of the assets, including the lease right-of-use assets, aren't really assets they can sell. So if they were to sell everything, they wouldn't have enough to cover the liabilities, which is very very bad. Another thing to mention here is the treasury stock. This is recorded at the time of acquisition, not updated to the current level. So this could be worth a couple of billion now or 10, 15, 20 billion if they recover. Then they can use it to buy other companies and stabilize and further develop. But right now, using stocks to fund anything should be out of the question for them. Again, 10, 20, 30 years ago, things were very different. All the physical locations, convenience, brand availability, discounts and stuff were important, but now, especially thanks to Amazon, the convenience is moving into online. But they are adapting, and even though American pharma remains the #1 source of revenue, the rest is also developing and they are taking action to survive. They expect closing about 500 stores in fiscal 2025 and about 1.2-1.3 thousand by 2027. As they say, a turnaround will take time, but they are indeed taking action very fast since the new CEO came. I think so far he did pretty much exactly what he had to do, maybe should have stopped the dividend even sooner. Again, when you lose money and have a lot of upcoming debt that you can't pay, you shouldn't even think about a dividend. But there is nothing that can guarantee a recovery, and even if they do it, they will most likely not be the same as before. Now let's see a valuation. In a bad scenario where they don't make anything or even lose money, it's tough to see them survive. There is literally no limit to how much they could fall because there is no equity, and if the current CEO's actions won't save them, I'm not sure anything can. Maybe some private equity fund could buy them for a couple billion and hope to win something in the bankruptcy process, but that's like an 80% loss. I think this gives a pretty good idea about the downside risk. Now, in a second scenario, if they manage to recover but remain significantly affected, let's say they make around 1.5 billion per year. For a ratio of 6, which is on the lower end of the usual 6 to 12 that we saw for them in the past, that's a 9 billion market cap. So that's pretty much the current level, which I think shows that the market has some optimism in the new CEO. The maximum dividends and buybacks in this case would be around 16.7%, so not bad if they do a 40-40 split and keep the rest, let's say. Now, in a better scenario where they manage to significantly recover, let's say they get back to 3 billion per year. For a ratio of 9, which is around the average, that's a 27 billion market cap, meaning a price of 31.36 for pretty much a 3x. The dividend in this case could be massive, even in the 20-30% area, so the market would very likely not keep it at such a level, so this would be a very nice multi-bagger. By the way, if you want to support the channel and see when I buy anything or even get a custom stock analysis or even 2 each month, check out the Patreon link below. And now you also get all the other analyses ever requested by other members on top. Now, it's impossible to guess the likelihood of these scenarios, but for a margin of safety, I normally want something below the second, as close to the first scenario as possible. I don't know, maybe something below 5, if nothing bad happens, very importantly, would be a good level for me to enter in my opinion. That's like a 2x in the second scenario and over a 5x in the better one, plus massive dividends in both. Again, it's all about the level of risk and reward you'd be happy with. Since the risk is high in this case and I wouldn't like owning the company, I really want a very good reward if I get in. So this is all about the company's recovery. If they do it, this is a multi-bagger with potentially very high dividends on top. But can they recover in time before a potential refinancing pushes them into an even worse state? It's impossible to know. This is, at the end of the day, the risk of investing in a business with a 1-3% margin. When the issues come, by default you don't have a lot of cash on the balance sheet to withstand them, you lose money, can't pay the dividend and are forced to adapt. And again, they are adapting, and judging by his actions, I actually have high hopes in the new CEO, but nothing is guaranteed. To be honest, it's getting kind of tempting as a high risk, high reward, small speculative position, but at the same time, it's much higher than a year ago, so for now I'll pass, but we'll keep an eye on them. As always, what I cover in my videos shouldn't be enough for you to make any investment decisions, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching and I'll see you next time.